Picture this. It's a Friday afternoon. You pull up your banking app to check your balance, but all you get is a glaring red error message. Access denied. You try the website. It's down too. A little knot of panic starts to form in your stomach. Your rent is due, groceries are on the list, and your own money feels like it's trapped behind a digital wall. For millions of people, this isn't some made-up scenario. It's a very real and stressful experience when system outages, fraud alerts, or random glitches lock them out of their accounts without a single warning. This plan is mostly for normal problems. Outages, fraud locks, transfer delays, not the end of the world. But here's the good news. You don't have to be a victim of a system glitch. This isn't about doomsday prepping or predicting a total financial collapse. This is about something much simpler: practical, smart redundancy. It's about making sure a temporary problem on the bank's end doesn't turn into a full-blown crisis for you. In this video, I'm going to walk you through a simple 3-step plan that makes it extremely likely you can access money within minutes, and within 24 hours, even in worst-case outages. The goal is simple: cash within minutes, backup cash within 24 hours, and full redundancy within 72 hours. You'll be able to sleep soundly through any freeze, knowing you've got a rock-solid plan. First, let's get one thing straight. When people hear losing access to your bank, their minds immediately jump to a catastrophic bank failure, like something out of the Great Depression. But the truth is, in modern FDIC history, insured depositors are typically made whole, but access can be delayed. The real threat, the one you'll actually face, isn't a bank collapse. It's a temporary access disruption. Think of it this way. There's a world of difference between a bank being insolvent versus its systems being illiquid or just offline. Insolvency means the bank has failed. In that case, the FDIC steps in to protect your deposits up to the insurance limit, which is currently $250,000 per depositor per bank for each account ownership category. But while that process is secure, it's not always instant. The much more common problem is that access delays can happen during outages, security holds, or resolution events. And here's the key. These issues can hit any bank, no matter how big or reputable. Even the most advanced financial institutions aren't immune to technical errors. A bank's servers could go down for maintenance, or a simple technical glitch could knock them offline. Your account might also get flagged for suspicious activity, like a large, unusual transfer, or even just a few failed login attempts, temporarily restricting your access as a security precaution. These disruptions can last anywhere from a few hours to several days. While you'll eventually get back in, a 3-day delay can become a massive problem if your mortgage is due Tuesday morning and the system goes down Friday afternoon. This is why redundancy matters. This is why our plan isn't about fear. It's about building a practical bridge over these temporary gaps. This connects to phase 2 in the crisis timeline. Funding stress, plus outages, plus freezes. It's about being prepared, not paranoid. The foundation of your entire bank access plan is the 2-bank rule. It's incredibly simple. Never keep all of your spending and savings in just one place. You need, at a minimum, 2 completely separate banking relationships. This is Financial Redundancy 101. Here's how you set it up. You'll have a primary bank and a backup bank. Your primary bank is your daily workhorse. This is where your paycheck lands, where your automatic bill payments come from, and the debit card you use for gas and coffee. This account is the busy hub of your financial life. Your backup bank has one job: to be your fail-safe. This account must be held at a completely unrelated financial institution. And I mean truly unrelated. It can't just have a different logo. It has to be owned by a different parent company. For example, having an account at Chase and another at Bank of America works beautifully. Having one at Chase and another at JP Morgan Investment does not work because they are both part of the same company, JP Morgan Chase & Co. The whole point is to sidestep a single point of failure, whether it's a server crash or a network outage. A great strategy is to pair a big national bank with a local credit union, or a traditional bank with an online-only bank. A crucial part of this is to keep the backup bank active and tested. A simple way to do this is to keep at least one credit card and one small recurring bill, like your phone or a streaming service, tied to your backup bank. This ensures the account stays active and you know it's working. Also, make one ATM withdrawal every 90 days so the card stays active. As a bonus, this setup automatically doubles your FDIC protection. The FDIC insures up to $250,000 per depositor per ownership category at each insured bank. So, by having accounts at two different banks, a single person can easily have $500,000 of insured deposits. Here are a couple of solid two-bank setups. Setup A. Your primary could be a major national bank like Bank of America for your main checking account. Your backup could be a high-yield savings account at an online-only bank like Ally or Marcus, which are entirely separate and often offer fantastic interest rates. Setup B. You could use a local credit union as your primary for that community feel and great customer service. Your backup might be with a fintech company like SoFi or Discover, known for their strong digital platforms. Once you have these two accounts, the final piece of the puzzle is linking them. Go through the process to set up an external transfer, usually called an ACH transfer, between your primary and backup. Then run a test. Send $100 from your primary to your backup, wait for it to clear, and send it right back. This simple test does two things. It confirms the link works and shows you exactly how long a transfer takes before you're in a jam. Okay, you've got two banks. Now, what kinds of accounts should you have at each? Using the right accounts is key to balancing immediate access to cash with smart savings. Your system should really only need two account types: a checking account and a high-yield savings account, HYSA. A checking account is your spending tool. It's built for frequent transactions, debit card purchases, and easy ATM withdrawals. You should have a checking account at both your primary and backup banks. The primary checking is for your day-to-day life. The backup checking account, however, will mostly sit quiet. Its only job is to be ready with a few hundred to a couple of $1,000s to cover immediate needs if your primary account is ever out of commission. The second, and arguably more important account, is the High Yield Savings Account, HYSA. This is where the bulk of your 3 to 6 month emergency fund should live. HYSAs are absolute powerhouses. They offer interest rates that can be many times higher than a traditional savings account, meaning your emergency fund is actually growing and fighting off inflation while it waits. Recently, many HYSAs have been paying competitive rates, often far above traditional savings. By parking your emergency fund in an HYSA, you do two brilliant things. First, you separate it from your daily spending money, creating a mental barrier that stops you from dipping into it for non-emergencies. Second, that money is working for you. It's still accessible, usually transferable to checking within 1 or 2 business days, but not so accessible that you spend it on a whim. And yes, you can have an HYSA at both your primary and backup banks for maximum flexibility. Let's also quickly clarify those FDIC ownership categories. The $250,000 insurance limit applies per person, per bank, and per ownership category. Common categories include single accounts, joint accounts, and retirement accounts like IRAs. This means you and a spouse can have a joint account insured up to $500,000 because each of you is insured for $250,000 as a co-owner, and you can each also have separate individual accounts insured for another $250,000 apiece, all at the same bank. Understanding this lets you maximize your protection. So, your step-by-step setup is simple. Open a primary checking account and an HYSA at your main bank. Fund that HYSA with the majority of your emergency savings. Open a backup checking account and an HYSA at a totally unrelated bank. Fund the backup accounts with a smaller, but still meaningful, chunk of your emergency fund. Set up tiny automatic monthly transfers, even just $25 a month, to your backup accounts to keep them active. For example, keep 1 month of essential expenses at your primary bank's checking account, 3 to 6 months of savings in that bank's HYSA, and then keep 1 to 2 weeks of essential expenses at your backup bank's checking account, plus a small HYSA buffer. This last step is what makes your plan real. A plan is useless if you don't know the numbers and limits that govern it. This is where we move from theory to action. First, let's talk about physical cash. Even though we live on our phones, cold, hard cash is the ultimate backup. If there's a major power outage or a payment network goes down, your debit cards and apps become useless plastic. The goal isn't to stuff your mattress with cash, it's to have a reasonable buffer for short-term emergencies. A good target is between $1,000 and $3,000 in physical cash, stored somewhere secure like a fireproof safe at home. That's enough to cover 3 to 7 days of absolute essentials: groceries, gas, medicine, if digital payments are offline. Next, you have to know your digital transfer limits. Every bank caps how much money you can move in a day or a month. You need to know these numbers for both of your banks before there's a problem. Log into your banking apps right now and find these 4 key numbers. And remember, these are just examples. Your banks will be different. ACH transfer limit. This is for standard 1 to 3 day bank-to-bank transfers. Limits often range from $5,000 to $25,000 per day. Wire transfer limit. Wires are for moving large sums of money quickly, usually same day. Limits are much higher, often $100,000 or more, but they come with a fee, typically $25 to $50. ATM withdrawal limit. This is your daily cash limit from an ATM with your debit card. It's usually between $500 and $1,000. It's crucial to have debit cards for both banks in your wallet. Zelle/app transfer limit. Peer-to-peer payment apps built into your bank often have their own daily limits, maybe around $2,000 to $5,000. These are great for sending smaller amounts fast. Verify these limits for your specific accounts. Put them in your phone notes and print a copy for your home safe. Check them every few months because banks can and do change them. Knowing these numbers tells you exactly what tools you have and how much cash you can access in a 24-hour crunch. You've done it. You have the framework for a bulletproof bank access plan. But just like a fire drill, you have to test it. I call this the 72-hour redundancy test. It's a simple mental exercise to run through once a month. Just ask yourself this one question. If my main bank account froze solid right now for the next 72 hours, what would break? Then, run through this checklist and be honest. Do I have at least $1,000 in my backup checking account ready to go? Is my backup debit card in my actual wallet right now? Have I tested the transfer time between my backup savings and checking accounts so I know if it takes 1 day or 3? Do I have my physical cash reserve at home, and have I checked it recently? Do I have a credit card with a low balance that can act as a third layer of defense for purchases? Do I know, or know where to find in 2 seconds, my withdrawal and transfer limits for my backup account? This simple checklist turns that vague anxiety into a clear action plan. If you answer no to any of those questions, you know exactly what you need to do. Fix the gap, move the money, test the transfer, put the card in your wallet. This whole plan is designed to be simple, cheap, and incredibly effective. It's not about fear, it's about control. It's about building a system so strong that when a small-scale banking hiccup happens, and it will, it's a minor annoyance for you, not a major crisis. This is educational, not financial advice. Always match this to your situation. So here's your action plan. It's simple. This week, pick your unrelated backup bank. Open the accounts online. It usually takes less than 15 minutes. Fund your backup accounts with a starting chunk of your emergency fund. Test the connection by moving a small amount of money back and forth. Once a month, run through the 72-hour redundancy test checklist. By taking these small steps, you'll be ahead of 99% of people who only think about their money when they can no longer get to it. You'll be prepared, not paranoid. If you found this guide helpful, hit that subscribe button and turn on notifications. Next video, Bitcoin Access Plan, self-custody, exchange freeze risk, and what not your keys actually means. Now I've got a question for you. Drop a comment below and let me know, what's your biggest worry when it comes to banking security? I read every single comment and I'm genuinely curious to hear what's on your mind. Stay prepared and sleep well. Next video, we build the next layer of the plan. Watch the plumbing, not the headlines.